Otherwise, my seminar can go for hours.
I know.
All right. But again, I think the important bit is the experience. You're dealing with somebody that has years of experience in the property tax, land taxes, stamp duty, FRB, the whole lot. But again, I think today's focus is probably more on taxes. So these first two slides, I wouldn't spend too much time. Actually, don't need to take any picture of that, because what I'm going to do is that if you can grab my business card, I'm more than happy to email you a soft copy of this, so you can keep it, you can read it at your bedtime if you can't go to sleep. So this will put you to sleep. All right? Yeah. So don't worry about all this. I'm going to go through one by one of them, and I know that I only got 45 minutes. Then now it's 2 minutes gone. All right. Now just a couple of things that you should know. All right. Now our tax authority, Australian Taxation Office, do track, okay, the number of people who owns property in Australia, and they keep account of everything that they take in, which is the income, as well as what they claim in terms of deductions. So they are not blind, okay? They are like the hawk, the hawk with the eyes on the air, watching over everybody. If people think that they can come in and invest in Australia and don't do their tax return, okay? And I got client come to me just a couple of days ago. There's one client, I think Madeline referred to me. I think it was 15 years of tax return hasn't been done, okay? And the reason why they are doing that now is because they decided that they want to sell the property, okay? So one key issue is if you want to sell the property now, as of 1st January 2025, there's a withholding tax on the sale of the property for foreigner. Okay, I'll go through that detail a little bit, but just last few slides that I've been putting up here, it tells you a bit about background, about income. Okay, these are all individual. We haven't talked about trusts, we haven't talked about company, we just talk about individual. All right, the income that they earn, and over the year what the net income is. So obviously the first few slides shows you the tax authority gather the information based on what people have reported. All right, now all the titles are up there, so I wouldn't go into that, but what I'll do, I'll talk a little bit about this. As you can see, all this line here on the top here, these are all the income, gross income. All right, and all this red one, this is the next column, are basically the net result. Okay, you might say to me, oh, but that's a lot of income. What happened to the bottom line? It's basically negative. All right, now it's because people know how to deal with it in terms of deductions. All right, we all know as a property investor, we love to collect all the income. If there's a rent increase, we want more. All right, as a landlord, that's the number one priority. So if you deal with your property manager, I hope Andrew is not here. If you deal with a property manager, you say, oh, you can only increase so much rent. Yes, true. Through legislations, okay, we have very strict legislation, how much rent increase you can have. But you have to always challenge them and say, look, well, I think you can get more for my property. All right, you always got to ask that question. They should be doing more for you to get you the maximum rent. So therefore, the only thing that you need to deal with, as of what I speak to you now, is what sort of deduction you're allowed to claim. Meaning that, what are the expenses deemed tax deductible? All right, you're going to know all this. Then you can plan ahead in terms of every time you want to buy a new property, you know what question you need to ask. Don't bother about asking income because you know you want a maximum income. But you also want to know, you make sure that you are maximizing your deductions so that your bottom line, you don't have to pay a lot of tax. All right, people already start knocking their head because it's so important. All right, now, just now you see that pie chart, I converted into numbers. As you probably can see, there's two items I especially highlighted. All right, people often said to me, What is the key when you buy property? Of course, number one, you want to buy the right assets. All right, assets that can bring you good tenancy, good rental income, good capital growth, which is on the first few slides I talk about. But at the same time, you want to make sure that you get very good income, but you also know how to structure it so that you are maximizing your position as tax deductions so that you don't pay taxes. All right? Now everybody knows, okay, in Australia, when you are Singaporean, especially Malaysian, all right, don't talk about Singaporeans because Singaporean very low binding, all right? Malaysian very dodgy, all right? You got one here, I'm a Malaysian, okay? Is they want to know how can I do it so that I don't pay so much tax, all right? So first thing first, structuring in terms of what you purchase and you can borrow money. Is the borrowing functions able to claim you any deductions? All right, because there's interest cost component. So key question, later on I'm going to run through it. There are some stuff that you need to be aware of. So I'll skip all these slides because you can read it at your own time. Very straightforward. Talk about non-resident, how many non-resident actually invest in Australia, report for tax. What are the trends? Whether local resident is paying more tax, they got more income, they should be paying more tax. Why is it non-resident don't pay lesser tax? Because we don't have a threshold in terms of income tax. All right, so I'll skip all that. But what I want to do is to briefly talk about a couple of terms. All right, terms such as negative gearing often get thrown around everywhere. All right, I think that one gentleman down there was talking to me. He said, "Hey, can I do this or not?" All right, I said, "Yeah, definitely you can." All right, but there are some restrictions what you can do compared to a tax resident and a foreign tax resident. Now, when you have a situation whereby the expenses is more than the income, so you create a scenario whereby there's a negative gearing impact, because by doing that, run through the whole exercise, I was able to get income, but my expenses is more than the income. All right, then do I have to pay tax? There's no tax implication as a result of that. All right, obviously on the reverse, when you don't do negative gearing, you do positive gearing. Typically, a lot of people, the older client that I have is they like to buy property and pay cash. All right, full cash from day one. Then, of course, they run into the issue about having to pay tax from day one, okay? Because income is more than expenses. Without the negative gearing impact, borrowing expenses, interest deductions. So things like that, these are little things. Now, these next few slides are so important. So when you think about buying property, you thought about financing, whether you should get finances or not. All right, so a lot of questions get thrown around and say, Albert, can I borrow from Singapore? The funds coming from Singapore bank, financing my Australian property. Can I get the deductions? All right, so there's a lot of tricks, I wouldn't say tricks, there's a lot of points, factors you need to take account of, is how do you link the borrowing or the loans that you receive from the Singapore bank to buy property in Australia? How do you link that? How do you create a relationship? Okay, but more often that I know recently, a lot of Singaporeans, when they lend you money, they give you a term loans. They like to use the word term loans. I don't know why. They say, we can't put on the paper and say, to lend you this money, you are using this money to go and buy Australian property. They will not write it in that. So how do you get around that? So I can give you advice on that. So what I always say, negative gearing is one part of the component in terms of buying Australian property, knowing that it's very taxing in Australia. So you have to try to maximize your deductions and therefore your borrowing. You see, optimize your borrowing. So often clients ask me, so what do you do? Okay, what do I ask the bank? How much should I borrow? All right, I always say to the client, you borrow as much as the bank can lend you. Okay, if the bank said, to buy $1 million property, we can lend you 600,000. Okay, I'll take it. All right, you don't try to renegotiate with the bank and say, No, 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 I don't need 600, 400 will do. Okay, I got client like that. They say, oh, why have to borrow so much? Then, after that, they bought the property, they settled the property, they borrowed 400,000. They think, and say, hey, my deduction is lower. If I borrow less, I could have just take the 600. Too late. Okay, why I said too late? Meaning that you cannot go and get another 200,000 and claim the deductions. Because why? You already borrowed the 400 to actually increase the financing. What's the purpose of refinancing? Borrow the money, you put back in your own pocket. You can't claim deductions. Unfortunately, it's private. Okay? So what I always tell the client is you do it properly from day one. If they say, we can lend you 600, take the 600. If you decided down the track and say, I don't need the 600, I can pay it down. You can always pay it down. So there's no reversing the whole effect. All right? So these are important. There are other things that I don't think that's relevant anymore. It used to be Australian banks are doing a lot of that. They lend to foreigner. They give you this offset account. Basically, it's another saving account that it's so-called you can put some money in there. They will offset the balance against your main, borrowing capacity. So reduce the interest cost. I tell the client, if you're going to maximize your borrowing, that's one thing you don't do. You don't leave money in the offset account. You take it all out. All right? You make sure your borrowing is maximum. But you have the cash. You can always pay it down. All right? Anytime that you want. But you don't do like the other way I just described about 2 minutes ago. You don't do that. All right? Now, there's refinancing. So there are options about that, buying new property. So things like that, it's about structuring. All right? Now, there are other things that I think is also very important. These particular things I'm going to show you a bit later on has a very great cash flow impact. All right? Now, depreciation means that you're allowed to do a building write-off. You're allowed to amortize the cost of the building. You're allowed to depreciate against the fixtures and fitting inside the building, such as the apartment. And it's tax deductible because you already own the property. So you're not paying for it, which you already paid when you bought the property. All right? So things like this, the one gentleman, that couple here, they bought the property. I think that's one of the things that I would recommend you to do because it's mandatory and it's a good idea because it helps you to save some tax. All right? Now, I'm going to show you this. All right? This is just an example. Say you bought a 2-bedroom apartment, cost you 700,000. Year one, you can claim automatically 18,600. By the way, this is only an estimate. All right, and accumulate the first 5 years is 75%, close to 80,000. All right, these are so-called deductions you automatically already entitled to being a property owner. You don't need to pay for it again. All right, unlike interest costs. You have to pay the interest costs, all right? In order to gain deductions, you have to pay council rate in order to gain deductions. But depreciation, no, it's all built in already, okay? Being a property owner. How am I doing so far? Okay, all right, I'm on track. All right, now, ownership. I think this is one of the things that often get ignored, all right? I'm not saying that you're doing it wrong. This is something that you should have considered, all right? Whether you should be buying the property between the husband and wife, or you should buy the property under one name. Or do you buy the property with yourself and your children, depending on their age? Why we do all that is because we can split income, all right? So imagine that you own the property. I own the property myself, all right? So everything comes to me, gross income. I gain the deductions. So all the income end up, the net income, I'll be taxed. So imagine that if I don't do that, if I split it between me and my wife, we'll be able to split our income. Now, there are other things that you need to consider is, obviously is, passing on the assets. All right? So these are the issues that you need to think about. It's more legal, more in terms of estate planning. All right? There are other issues that you also need to consider is the capital gain issue. which I'll talk a little bit more about that. Not just splitting the income, taxing is one important thing. It's also survivorship issue you need to consider, all right? Now, a lot of people often tell me is that, when I bought the property, what are the information I need to keep? All right, now I tell client this all the time, all right? You should keep everything, all right? Now, even better now. Used to be we keep a lot of paper, right? We got to store the paper in some way in the cupboard, and then when we bought the property, we keep them. When we sell the property, we got to pull them out and send it to Albert and do the taxes and all these things. Now, it's so important. All right, nowadays, modern day, very easy. You can scan everything, you put in the computer, you can store in the cloud. You can do whatever you want to do. And then when you start selling the property, then you have all those information. I have clients, which I bumped into one yesterday as well, when I was in Melbourne, is I say, I sold the property. I say, when did you buy the property? Back in 1982. I said, 1982, do you have the document? And guess what? He pulled it out as a contract of sale. And the title, 1982. I said, congratulations. 1982, that's pre-CGT, pre-capital gain asset. No capital gain tax. Wow, he was so happy. All right? So these are the lessons we learn, that you got to keep everything. Keep everything, all right? All right, send it to us. We do have a very good database. We keep all the costs when the client bought the property. That includes what they pay for it, the stamp duty, additional stamp duty if they pay for it, FRB charges, you name it. All right? Then, of course, the other things that we do is that we do the annual tax reporting. Keep their reporting to date. Know exactly what taxes they pay. If they don't pay any taxes, they got losses, they can actually carry that forward. All right, you can accumulate, you can carry forward. Now, I often have clients come to me and say, I haven't done my taxes for the last 15 years. I know I make losses every year. I say, how do you know? I just think my income, my expenses, for sure, expenses is more than income. I say, can you substantiate that without doing your tax return? Of course you can. All right? When it comes to utilizing the losses, you want to be able to make sure you crystallize the losses, meaning that we record it, you report it with the tax office. The tax office actually tracks the losses. We track the losses by doing the client tax return. The tax office actually know. All right? And they know when you want to use those losses. Say, for example, you have accumulated losses over 100,000. Now you want to sell the property. You make $100,000 of capital gain. You can use those losses. But if you haven't done your tax return, how much losses do you know? You're just guessing. And you can't substantiate that. That's the problem. All right? I'll talk a little bit more at the back end when we deal with the capital gain. All right? Now, this is something that people don't like. All right? Especially foreign tax resident. You see, from $1 onward to 120,000, you have to pay about a third away. All right? This is why I say it's very taxing. All right? So if you imagine that you are positive gear, you have to pay tax. These are the so-called tax rate. All right? But of course, a lot of my clients are sitting here. Not a lot of them are here. Because why? They know how to structure. Okay? They get the right advice. How much loan they should take. How much is the property price? How much rental income? How much deductions? Every year they report. So we accumulate that. So not many clients are paying tax as a result of that. But this is why it's so important. So I'll show you that last one. So hang on, sorry. How do you go back on this? Let me just do this properly. All right. Now this 2024. Okay. You see that changes? 32.5%. All right. This is year 25. So they have reduced the so-called tax rate. down to 30, there's a reason for it. All right. Now, before this 2025 come, there's a lot of clients asking me, all right, Albert, we have to pay 32.5%. What's the corporate tax rate? All right, that's a key question, right? What's the corporate tax rate? Australia corporate tax rate is 30%. You say, why as an individual we want to pay 32.5%? Why don't we put the property in the company and pay 30% flat? Makes sense. Why? Because once you jump up, okay, if you go back again, when you go up the scale of income, you pay more. Marginally, you pay more, right? So it's so important that you understand why people are start looking at buying property under the company. Not that I'm preaching it at the moment, I'm not actually, but it makes sense now that it's at 30%. All right, because a lot of people will be on this bracket. Hey, the Australian government and the tax office, they do their homework. They know exactly what people are thinking. You say you want that 30%, I give you that 30%. Because most of you are on this level. All right? So everybody will be complying under the individual. Nobody thought about doing the company. All right? Even the company, it might be attractive at 30%, but again, there are a lot of other things that you need to consider. Compliance costs. As you know, right? Singapore, you set up a company, the account needs to be audited. All right? You need to pay the accountant, you need to pay the auditor, and you have to pay the tax. So unless you are buying and you are investing in multiple, when I say multiple, not 2, 3, it may have to be 5, 6, 7. All right? I do have a couple of clients, individual from Singapore, 35 property under husband and wife, and they haven't paid any tax for the last 12 years. All right, because they already gone through that process with me, structure everything correctly. All right, but I can see in the very distant future, they will be paying tax, but they have accumulated a lot of tax losses. I think one person probably about 400,000-500,000 tax losses because of the depreciation, interest costs, everything. All right, so these are the things that I do and I manage for my client. All right, now that's all the income tax I want to talk about. Now these are the things that you don't want to know. All right, or you don't like to know, because there is a lot of taxes happening with different government in Australia. I mean, land tax is one of the taxes that is not administered by the federal government, it's administered by the state government of the Australian states. All right, it's a bit like Malaysia. Imagine Malaysia have 13 states, is that right? Yeah, so they have state taxes. This is the state taxes. Now, this first snapshot is to give you an idea what it looks like in different states. You probably already guessed is you start looking at, say, my God, Victoria, I had to pay a surcharge, 4%, all right? New South Wales, Sydney, 5%. Then you ask yourself this question, say, do you want to be investing in those states? All right, because land tax is a holding tax. It's your property tax. Basically, it's a property tax based on the land value. All right? Now, Brian has asked me to do a more detailed land tax. All right? If you are thinking about investing in Sydney, all right, or any part of New South Wales, these are the land tax you need to be aware. Maybe I'll give you some number, it makes more sense. All right? Now, in New South Wales, from 2024, if your property is currently, from 2024 onward, your land value has to be more than $1,075,000 in order to pay land tax. That's good news, right? Because number one, New South Wales property is very expensive, all right? Land value is high, but if you have property that has land value lesser than that, you don't have to pay any land tax. But it's always a but, okay? But there is this thing, okay? I'll come back to this one later on, this surcharge thing. There is this thing called absentee owner surcharge. Basically, it's the additional land tax on foreigner Okay? On foreigner, that's 5%. All right? So you can imagine if your land value is like 500,000, you multiply that. So even though you don't pay land tax, you have to pay the absentee owner surcharge, basically the additional land tax. They're two separate things. Okay, one land tax, one is the surcharge. All right, now the rules are slightly different in Victoria, which I'll identify for you. But let's go back to this, this absentee owner definition. Okay? Okay, the New South Wales or the Sydney definition for absentee owner is different. Every state has got their little tweak in terms of the definition for absentee owner. Basically, it's foreigner. All right? New South Wales is very strict. Okay, it says if you're not a citizen of Australia, you are deemed to be an absentee owner, or if you have not lived in Australia for the 200 days or more, okay, in the 12 months period, you are deemed to be an absentee owner. Okay, then I'm going to show you later on. Okay, just remember this now. I'm going to show you later on what the definition for Victoria. Okay, Victoria do have land tax, right? All right, it's kind of like the same as New South Wales. All right, I'll come back to this one later on. This is Victoria. If your land value is more than 50,000, or less than 50, sorry, you pay no land tax. All right? If you are between 50 to 100, it's $500. All right? Now, rules are slightly different in Victoria is they do have absentee owner surcharge, but you have to pay land tax before you pay absentee owner surcharge. New South Wales is you don't pay land tax, but you still have to pay surcharge. All right? Now, I have many clients, it's like telling me that, hey, Albert, before 1st January 2024, my land value is like 100,000. I pay no land tax, I pay no absentee owner. What happened? 1st of January 2024, 100,000, I pay $500 plus I pay 4% on the absentee owner surcharge. Okay, hey, hang on, where is it now? Coming back. Sorry. Where is it? Did I miss a slice? I think I did. Oh yeah, here. 4%. So that's 100,000, 4%, that's $4,000 plus $500, $4,500. That's a lot of land tax to pay. All right, for $100,000 land value. All right, but imagine that in New South Wales, if you have a land value of 100,000, you only pay $5,000. All right, without paying land tax, you pay absentee owner surcharge only. So these are the real difference. Now, of course, as a tax practitioner, we don't actually practice land tax, but I know enough because I have so much client. You know, I have over 1,000 clients in Singapore in property only, nothing else. They just buy property in Australia, everywhere in Australia, all the way from Northern Territory in Darwin, right down to Tasmania, around the East Coast, West Coast. All right. So we handle a lot of property tax related matters such as land tax. Now, I promise you that I'm going to come back to you about this absentee owner definition for Victoria compared to New South Wales. I've been dealing with this issue for the last 2 years because we have a lot of clients in Singapore who have invest quite heavily in Melbourne. Now, question need to be asked. How do you define yourself as an absentee owner in Victoria, where you own property in Victoria or in Melbourne? If you're not an Australian citizen or a permanent resident, remember the New South Wales citizen only. They don't talk about permanent residency, all right? So if you also don't reside in Australia, all right, and residing means that you do not originally reside. It means the 183-day test. New South Wales 200 days. Okay? Which is this one is 6 months. right? So we talk about 6 months, right? So because of that, a lot of people don't qualify. They're basically absentee owner. So they pay the $4,500 based on the $100,000 land value. Okay, so these are the so-called land taxes that you need to consider when you buy property. Now, how am I doing my time? 15 minutes. Okay, I can spend more time on this. This is more important. Okay? We do have capital gains tax in Australia. Okay? Capital gain tax is part of the income tax. You want to say assessment when you sell property. So obviously you pay tax on the profit that you make on sale of the property. Okay? All right, now, of course, assets also means if you have bonds, you have gold, precious metals in Australia, they are deemed to be part of the assets, including property. All right? Now today, just for our exercise, we talk about property. Now, how do you work out your capital gain? All right, remember I talked about a lot of other things about capital loss. You know, you can accumulate your capital loss. So how do you work out your current year capital gain? You work it out by taking account of what you sell your property for, take out the cost of the sale, including the agent's commissions, selling expenses, marketing costs. You need to fix up the property before you sell it. You can take account of all that. Then you work out that's what you call your capital gain for the year for that particular property. Then you deduct any capital loss that you may have for the current year. For example, you might have sold 2 properties. Okay? One, you make a gain. One, you make a loss. You can offset that. All right? Then you also take account, next item is any capital loss that you may have incurred on the previous year. This is where it becomes tricky, all right? Because people will tell me, hey, I sold property this year already. And then 10 years ago, I bought something in Australia, I sold it, I make a loss. That's why I don't report. I say, who told you you should not report? You should actually report it. Because why? You need it now. If you don't have it, how am I going to claim that part for you? You can't offset, right? Correct? Yeah. So the other thing that this one is probably already run out of time is this what we call the general capital gain tax discount. All right. It used to be we had people telling you that you buy Australian property when you make a capital gain, 50% is taxable. That's prior to 2012. Before 2012. All right. We still have some clients have that. Property, our client have bought property 10, 20 years ago, all right? So they're entitled to some discount. So we are dealing with issues such as the 8th of May 2012 valuation so that they can gain some discount advantage on the capital gain. So partial capital gain discount. So we deal with all that issue. The next thing after that, then you deal with all the other losses that you may have, such as your rental losses. Remember I bring up the example earlier on, $100,000 of tax losses because of your rental minus your expenses is negative, you're allowed to carry forward. You can use that to offset, all right? Now, this is not new. Okay, again, I must say this to the client. I've been dealing with this issue for many years. This is not a new tax. People often tell, hey, I never hear about this before. What's this nonsense about this foreign resident capital gain withholding? What's that? What's that? That rule actually comes in effect 2016, but it's in a different form or shape. All right, I think that when they first started, they were talking about if you sold your property for $1 million, selling price above $1 million, 10% or something like that. So they start tweaking the rules over the years. All right. Now, this is the real one. Okay. Last year, 2025 January. Okay. The new rule, not new rule, tweak, change, update, whatever you want to call it, is withholding tax is 15%. Okay. No more threshold. Before that rule comes in, just a year before that, is Anything above 750,000 in terms of selling price at 12.5%. All right, and they have tightened the rules, saying to everybody, don't care. You start selling your assets more than $1, you already hit with 15%. All right. Now again, I say this is not a final tax; it's a withholding tax, right? So they withheld the tax 15%, and then you still have to lodge your return to substantiate your capital gain or your capital loss. If you have a capital loss, you get back your 15%. All right. Now it becomes tricky. It becomes tricky now because there's a lot of clients currently, or 10 minutes left, okay? There's a lot of clients currently try to sell their property, all right? And the worst nightmare come, all right? They haven't done their taxes for the last 10 years, 15 years. They have to sell the property. And they are, should I say this? They are lawyer, okay? I use the word lawyer. They are conveyancer. Tell them that, hey, you can go and apply for a clearance certificate. The answer is you can't. As a foreign tax resident, okay? Doesn't matter whether you're a PR. Once you're a foreign tax resident, okay, say your example, you become a PR, but you're still a Singapore tax resident, all right? You are considered as a foreign tax resident. You're not qualified to get a clearance. I have to have an argument with a lawyer to tell them that you're wrong. The client can't claim it, all right? But the client still can entitle to a variation, meaning that you vary that 15%. You can tweak that 15%, but you need to do an application and apply to the tax office within, you got 28 days before settlement. All right, this is where the client get undone when they don't have their tax return up to date. Because there's one of the conditions from the tax office, in order to approve your variation, your tax return must be up to date. If not, they won't approve it. Then you get hit with the 15 month. So we have many clients come to us, have done the sales, 15% has gone through, taken out from settlement, right? Means that you sell your property for $1 million, 150,000 taken out. They give you the 850, but they give you a certificate and say, look, while we have withheld the 15%, there you go, that's yours. So you know what they have to do? They have to get all their taxes up to date and lodge their capital gain tax return, show them what's the capital gain, whether there's any or zero or negative, try to claim back the 150,000. So we're dealing with that on a day-to-day basis. All right? So it's so important. Tax filing has to be up to date before you even consider. Otherwise, your 15% will be stuck. All right? And we have some client has got this imagination. He's saying, oh, look, definitely I make a loss. Definitely. And then guess what? When we finish the calculation, you make a capital gain. You have to pay tax. Your 15%, what you're supposed to get back, has been diluted in a way. All right? Financial person will tell you that's not clever. That's actually quite stupid anyway. All right? But again, some of these carry forward losses are so key to these things. That's why I encourage the client, their tax return has to be quite up to date. All right? Now, for some clients that are here, which hasn't done that, our tax year is from 1st of July to 30th of June, and you got 4 months after 30th of June to lodge your return. Otherwise, you have to rely on people like us, the tax agent extension. We can write in to get extension up to 9 months. All right? Anything beyond that, we have to get special permissions. All right? But we still have client that hasn't done the taxes for 15 years, still come to me and say, Albert, can you do this? And I say, when do you want it done? It's supposed to be done yesterday. I say, no. People try, right? So I get all sorts of things coming to me, all right? But for the new buyer of new property or already settled, these are what I call so-called the timeline, all right? If you have decided to say, I want to buy some property this year, January is the month that I want to buy, I want to commit it, I want to go ahead. I would say once you sign the contract, first thing first, you got to get your tax number done. Okay, because why? It takes 3 months to get it approved. Because the sort of compliance, the verification, the KYC, you can name it. And then they got to see the contract of sale, they got to make sure that these are all compliance. They need a certified copy of passport, your Singapore IC, with the addresses. They need to match with the contract, make sure everything is right before they issue. Okay, I tell you what, 4 minutes. I got to deal with one client the other day just before I come on the Thursday. It was sent by a lawyer. This is so funny. This is not funny at all. The client is a 93 years old lady. All right, has last time did the return was 2017 and hasn't done a tax return. Was thinking about selling property, but get told can't do it because why? The name is all wrong. Okay, the name previous tax return has got one name. The name is very long. Okay, or the title is six letter words name. Cannot match with the tax office record. You imagine the amount of administrative nightmare I have to deal with. Once the certificate of that withholding tax is being issued by the tax office, and then you lodge a return, is a different name, you can't even get your credit. So always do it correctly from day one. Okay, very important. Line up your title, line up your tax file number, your passport, everything has to be the same. All right? Don't try to be funny. All right? Because if we want to get the tax office to change the name, it's impossible. It's impossible. Okay? All right? So these are some of the things to engage us. So we require you to sign an appointment of tax agent. There is a form that we want you to fill up to give us all your detail, your personal particular, date of birth, and so on. Of course, we still need your passport, your IC. Then we deal with the tax number applications. Depreciation report, okay? You need to have one. Then, of course, we have a checklist. Our checklists are quite comprehensive. I think there's about 3 or 4 pages long. They give you the whole rundown in terms of when you bought your property, what are the documents you need to keep, all right? And yearly, when you do your tax filing, what are the things that you can claim? So we have all that, so you can take it off as you go. All right. Do I have 2 minutes to take a question? Oh, no question. Oh, yeah. Okay. Fine.
Earlier they were showing us Aura, right? So example, the apartment which will cost about 700, say just under a million. What would the land tax be for that sort of?
Okay, that's a good question. I think the first thing first you need to ask question is to ask the developer. You may be able to ask the developer or the selling agent or the sales rep in terms of what the land value is for that particular property. I think the issue that you may run into now is you won't get an answer until the property is completed, the land is so-called subdivided into strata title. Then they will allocate the land value. But obviously, you can get an estimate. Then you can work out your land tax component.
I mean, we don't know the answer now. That's a short answer.
Okay, based on previous examples, can you give me just an estimate?
I can't give it to you. They will give you an estimate. Again, estimate is an estimate.
Yeah.
All right. So they will give you an idea. But you also have to take account of the land tax regime may change over time, which is something that I can't guarantee you that if I give you the information based on what it is now, 5 years later or 3 years later, if they change it again. Yeah? So that's the answer. Okay, I'll take the lady at the back first.
Can you find out before about the depreciation cost for your property that you mentioned?
The report itself?
The depreciation cost, yeah. How can you find out?
How do I find out? I can't find out. You have to engage. You can come to us. You basically have to engage a quantity surveyor, which is on our panel. We will recommend you. Most likely, if you come to us, we would get at least 2 quotes for you from 2 different QS on our panel and come back to you with the cost. All right, they will do the whole lot. So the way that I normally deal with that is if the client comes to me, if they've been given a report, which is a 1-pager, I'll tell them that you can put that in the bin. So the report by the proper QS is about 15 to 20 pages long. You identify specifically on your property what the land value is, what the building cost, and the fixtures and fitting, and what are the so-called the schedule of depreciation from year 1 to year 40. Yeah, you only do it once. It's not a yearly cost. All right, so this is a.
Also, beyond certain year, that depreciation cost is no longer can apply.
Yeah, they will spell it out. They'll spell it out. So again, it's a 30 to 40. Well, sometimes it's 30 pages long, depending on how complex it is. But our experience is that we only deal with a QS that we think it's called so-called. The report is a qualified report. Yeah, and endorsed by the tax office. Yeah. Okay. Question.
For cash withholding and losses, where does it end? Can I include my loan from Singapore Bank to Australian Bank, and then the losses in the exchange rates? I started at 1.4, now it's 0.87.
Okay. All right. Well, maybe I'll give you a shorter answer to that. When you submit all your information to us to do your yearly taxes, if the loans is in Sing dollar you borrow, so provided first thing qualified first is that the loan has to be linked to your investment. That's the first thing we check first. If it's not, then you're not allowed to claim it. Okay? Because we have clients try to do that. They borrow the money today, the property is not ready for settlement in 2 years' time. They take the money, they go around the world. Okay, and then they say, oh, we're using that loan, settle in 2 years' time, that money gone there is linked to that. I said, look, sorry, no, can't claim it. Okay, that's the first one. The second thing is that if you're allowed to claim it, normally with a Sing dollar loan, we will use an exchange rate provided by the tax office to convert that back into Australian dollar, because your tax return in Australia has to show all in Australian dollar. All right, if it's Sing dollar, you move against the exchange rate and convert into Australian. All right, so you don't lose anything, so you'll be taking account of the exchange rate, but on the tax office end in Australia, based on their exchange rate. It's actually provided by the Reserve Bank of Australia. Yeah, it cannot use the Singapore Reserve Bank, sorry, unfortunately, Central Bank cannot use it. Okay? All right, I think that's about it, but I'll be around, and I'm happy to answer any question. All right, so I'll be here. All right, so you can come here. All right, thank you. Thanks, man.
Thank you so much again, Albert. Most times we get Albert online to come and talk to you via on the screen, so it's once in a while we look at Albert in person. So now that he's here in person, please don't let him get away so easily. Ask him more questions.
Only for him.
And
And prod next.
And yeah, so basically, I think that concludes today's seminar. I understand some of you were talking to the sales consultant earlier on a little bit about the EOI, and we did get a lot of interest, which is fantastic. So if you want to pick up the conversation again, most of the sales consultants are outside waiting for you as well. If you have text questions for Andrew Wang as well on rental, he's available here as well. If you want to learn more about the project, our team is here. We'll ask about taxes, Albert is here as well. So again, thank you so much for taking time out on your Sunday to come and learn this. We hope this was an illuminating session for you. Like I said, in PropNext, we don't just want to sell property. We also want to imbue our customers with the necessary knowledge so that every decision that they make is an informed one. So years from now, they cannot call us and say those words that every agent hates to hear. Why did time never say? Right? So now we're telling you everything up front. Right? And again, just to answer that question on the land tax as well, the developers usually will give us some sort of value if there were different stages. So like in Melbourne Square, we're at stage 3 now. Stage 2 is not completed, but we do have stage 1's numbers. We will ask them for it basically. As I understand right now in CBD, in recent times, The one bedroom typically is about 50,000 and below, which means you don't pay any the absentee owner land tax. But of course, once you cross 50, you have to pay. So, but again, every project is different because the land that you sit on is different as well. So therefore, it is a very sort of, I can't use one big brush stroke and then cover all basically. So like in our case, like I said, I believe Melbourne Square Stage 1 will have some sort of land value, so you could use it to extrapolate. But then your extrapolation or my extrapolation or even Albert's extrapolation or the developer's extrapolation is everyone's best guess. Alright? So until the council comes out with the land value, it is open season in a way. You can guess, but it's about there. Right? So with that, thank you again, and we are all here to help you as well. Thank you.